Courtney, good to see you again. How are you doing?
Great. Thanks for having me, as always.
Awesome. Let's talk about your predilection or your leaning toward international or emerging market equities. What do you see there that persuades you that they may be a place to put money now?
Yeah, we remain with the idea that it has an important part of your portfolio. I wouldn't say I'm leaning more towards that than US. We actually still have more US exposure than we do EM, but I absolutely want it as part of your portfolio. And you're really starting to see the sentiment shift there. If you look at China, for example, that's really what people think of when they think of emerging markets. And the tech index in China is off 20% from its lows, meaning it is officially in bull market territory. And Morgan Stanley did just come out to show that investment managers are less bearish. So I guess less pessimistic on it, if you want to take that for what it's worth. But they really have been underinvested in China, as have individual investors. At a certain point in time, I do think you're going to see more money go in there, which may already be happening. It's something you want to make sure you're positioned there before that leg goes higher. Now, we want to own emerging markets as a whole. So like Vanguard Emerging Market Index, VWO is a good way to look at that. EEM is the iShares version of that. China is about a fourth of that. So you also have India as the other big name or big country exposure that's going to be in there. So we want to broadly own it, but absolutely you want to make sure you have that as part of your portfolio.
You kind of pre-answered one of my questions, which was, is it better to play a fund here or to go and try and pick individual stocks? I guess your answer is go with a fund. There is no typical investor, I realize that, but what would be a sensible percentage in one's portfolio for, let's say, a typical investor for emerging markets? Is it 10%? Is it 25%? What would you say?
It completely depends on the investor and the time horizon. I would say for most of our clients who are long-term investors, we don't have any more than about 10% of our equity exposure there. So it's enough. We can take advantage of that upswing, but not so much that as it is volatile or if this political risk in China does continue, you don't want it to drag you down either. So it is going to be a longer-term play, absolutely.
Are there ways to play emerging markets without including China?
There are. And actually, iShares came out with a fund specifically for this. They have an emerging markets ex-China fund, which I've had a lot of clients ask us about because the idea of emerging markets, a lot of people are on board with, but the political risk in China is what's keeping people out of that, which I do think kind of contrarian is actually probably a good sign that people are so nervous with it. But there's absolutely ways that you can get into it without China and still play the broader EM markets.
And are there particular regions of the world that you mentioned China, but India, Brazil, are there other regions that you think are really poised for investors to see outsized returns on their investments?
Yeah, I think India is easily the other big one. They actually just surpassed China in population, and you're actually seeing companies are really starting to turn their focus there. Whether it's they're looking at moving manufacturing processes there, but also just realizing how big of a population boost that's going to be, I think is probably going to be the next thing that we're talking about over the next 5-10 years. It's probably India more so than China. So absolutely, if you're using those funds, that gets you the next second largest exposure, almost as much as China, just a few percentage points less.
Let's bring it back to the U.S. The industry with the fastest earning growth in the S&P 500 next year will be healthcare REITs. Tell us about that.
Yeah, which is interesting because I think a lot of people have been very negative on real estate because with interest rates being high and especially any potential issues with those upcoming redoing of the debt that's going to potentially be higher could lead to some issues there. But a lot of that has really been priced in. And if interest rates do, in fact, come down, I think you're going to see a lot of relief there. And healthcare, which we've talked a lot about, does come with real estate exposures. That's why healthcare REITs are actually, interestingly enough, one of the highest sectors of earnings growth when you look at 2025. I think absolutely something that you want to make sure that you're forward looking there.
Courtney, thank you for the advice. Appreciate the perspective.
Thanks for having me, as always.